Hello, everyone. It is Wednesday, October 12th, and maybe, just maybe, the market's showing some signs of investors willing to take on a little bit more risk. Let's take a look. So in order for these charts to make sense, we have to first understand what are high yield spreads. Okay, high yield spreads is the difference in yield or interest that you're going to earn on high yield bonds, also known as junk bonds, versus investment grade or treasury bonds. Okay, junk bonds are riskier, therefore they have to pay you more. Okay, if a junk bond is yielding 6% and say the 10-year treasury is yielding 3.5%, the high yield spread would be 2.5%, the difference between the two. Okay, tighter spreads mean risk is on. People are willing to take on risk. Okay, as people sell junk bonds, right? I don't want them too much risk. The value of these bonds go down, and therefore the yield or the interest goes up, right? And vice versa. People want them, if they want to take on that risk, then the value of the bonds go up and the interest rate comes down. So as these yields get tighter, people are willing to take on more risk. As these spreads get wider, they're saying risk is off. I don't want to take that risk. I'd rather buy treasury yields that are safer than junk bonds. Okay. So let's take a look at where we're at today. You can see in this upper panel, high yield spreads are higher than they were at the lows in June. Okay, you can see that by that red dotted line. This data is from Fundstrat, research partner of ours. In the bottom panel, you will see this is the S&P 500. Okay, the S&P 500 is making new lows here this last week, whereas the high yield spreads are not. Okay, typically these would move in conjunction with one another. Well, when else did this happen? Well, in October of 2008, you can see in this upper panel, high yield spreads hit the low. Okay, March 2009, they're significantly higher. Well, what would the stock market do? October 2008 was not the low. March 2009 was the low. So you can see high yield spreads started to move upwards before the market did. So this could be happening today. Not saying it's going to. These spreads could still blow out. But right now, the market is showing an initial sign that they're willing to take on that bond risk in the market. Another look is by looking at the correlation to S&P 500 to small caps. Okay, so this chart is of the S&P 500. Again, that green circle is the low in June, okay, and that red line running it across. You can see that we have now fallen below those June lows, okay? The S&P 500 is setting new lows. However, small cap stocks are not. Okay, small cap stocks, smaller capitalization, lower profits, sometimes even unprofitable, right? Deemed to be riskier companies to invest in, okay, not hitting new lows. This is another sign that the market may be coming to the table willing to buy risk. So still a long ways to go, a lot of things to figure out, but some early signs that the market may be willing to take on more risk, which could then start to build some momentum to the higher side. So hope you have a good rest of your week. Call us if you have any questions, and we will talk to you all very soon.